Welcome to the Holistic Wealth and Health Podcast. Your co-hosts, Jason Smith and Bryan Bibbo, will inspire and teach you how to prosper in your mind, body, and spirit, not just your financial life. Joining forces with field experts, Jason and Bryan are here to help you focus on what matters most in your life, living well.
Hello, everybody, and welcome back to the J.L. Smith Holistic Wealth and Health Podcast for another episode. I'm excited to talk about tax management after tax season. We brought in a special guest from our Minnesota office, Seth Meisler. He's a seasoned financial advisor and a chief investment officer with 17 years of experience in strategic financial planning, tax management, and also with wealth management. He holds a chartered financial analyst. He's a certified financial planner and a certified public accountant, along with an MBA from DePaul University and a BBA from Michigan University. He's passionate about simplifying complex financial matters. Seth is an active member of professional organizations, contributes to financial publications, and serves on the board of the 6 Points Theater. Seth, we're lucky to have you here today.
Thank you very much, Bryan. An honor to be here.
Absolutely. So I know taxes over your career have been near and dear to your heart. Why don't we go back in time? Tell us a little bit more about yourself, a little bit about that history, and how taxes became part of your financial practice.
So I started my career in public accounting as CPA, and so did both audit and taxes, mostly partnership and corporate, as well as personal and individual taxes. So did both. Did a little bit of not-for-profit work as well on some of the accounting side too.
That's awesome.
So I've served both on taxes and then as well in the corporate side doing assistant controller, help take a company public, doing kind of filings for that as well. And international companies as too, working on consolidating operations, both, U.S. and international subsidiaries. So really kind of a big accounting background. I mean, that's really where I started from. And then transition, kind of different areas, and eventually found myself in the financial planning arena, first starting out more in the chief investment officer role, doing analysis of companies, funds, etc., and then working with individuals. Along the way, I was doing tax returns for family and friends and on the side. So the tax part never ended. What's funny is that when I started back, I think in the Stone Age, like the 1986 Tax Act was still a really big deal at the time, as that we were still trying to digest it. And here we are, and we're back to trying to figure out what the tax law is going to do and what's going to say. Like things tend to have kind of like the J.L. Smith circle right behind you. That's how tax law is. It tends to go in circles.
I love it. Yeah, 1986, a long time ago. That was the year I was born, Seth. So yeah, definitely Stone Age times, no doubt about it. So that's great. But where did the transition happen for you? I heard the public accounting career, and then where was the intersection where the financial planning started to get into your day-to-day function, and you saw, hey, I should marry both these things together?
So again, in the career I had, I went from public accounting into the corporate side, doing accounting for companies. As I was doing it for a equipment leasing company for a really long time. And then I got interested in getting involved in other areas of the equipment leasing company, including credit. And then doing credit, you're doing analysis of the company, like can they pay their lease? What are they, how do they do that? And then I became involved in company analysis, got my MBA, got my chartered financial analyst, and decided I wanted to kind of follow on that analysis side of the house. And met up with a financial planning firm. They were looking for someone to do that type of work. As I started getting into that work, doing the analysis for the company, for the firm on different investment types, started getting involved in the client relations as well. then saw that tax issues were really, really important and really could move the needle. Still had a hand in the tax world. And so just really, it was a pretty easy to marry that. So very quickly, tax planning, tax management became a cornerstone of my work with, working with individual clients.
Oh, that's great. I appreciate that background. That gives us a bigger picture of, how you're still helping people on a day-to-day basis with that tax management and putting it into their financial planning. Because one thing that we know, a lot of tax preparers out there are just pretty much historians. They're just doing the tax return that happened from the year before. And with that being said, Seth, now we're past filing 2024 tax returns, and we got to start looking at the year that we're currently in. What are some things people can start doing now to get ready for next year when they're filing their tax return? I know it's never too early to start preparing, but what are some tax strategies or some different things we could be thinking about?
Yeah. So I think as we're talking about this, I'm reflecting back in the Stone Age, the motto for CPAs at that period of time was defer, defer, defer. In other words, defer taxable income to a future year. Why pay it this year when you can pay it next year? And that was kind of the basic motto. That's what we were working with at the time. Today, that seems really antiquated. And I say tax planning is like 3D chess at this point in time. It's become really complicated. And in my mind, I think we say tax season ends April 15th, but I think it never ends. It really is a continuous process. And especially now where we don't know what the tax law is going to look like for next year. We don't know what's going to be in, what's going to be out. And we can talk about that a little bit. But it really becomes a process of really immediately reviewing your tax return, looking at what's going on, and starting to look at what is going to happen for next year. What's your income going to be for next year? What's your salaries, compensation? Do you have any pensions? Do you have any deferred comp, annuity income, RMDs, et cetera? And really starting to roll that out with what we know. And there's a lot that we don't know, but really trying to roll that out and really thinking about it across time. So it's not even just like, okay, what's going on in 2025? It's what's going on in the next 5-10 years. And really to be planful of what's happening and in terms of your income, because you have a lot of ability to time recognition of income and expenses. And you don't want to go through it with kind of rules of thumb and what's, and conventional wisdom, because that may not work in your situation. I mean, I know that you and I have had conversations together with clients where you've talked to them about if you recognize income today, could cost you money versus pushing it off to like a year from now or 2 years, or the exact opposite conversation could happen. Like, yes, you need to recognize income today. We want you to recognize a lot of income today, because by doing so today, that reduces your income in the future. So it's almost never ending at this point in time.
Yeah, you talk about that paradigm shift, and that's what I'm going to refer to it as. Is so many people out there just look at taxes and they go, it's a once of a year event, right? They say, hey, February, March, April, it's a one time a year event. People don't look forward to it. They're just plugging their stuff into TurboTax, whatever it may be. But gosh, I think you really nailed it home there, Seth, of looking at it. It's like it's a year-round thing. I know for my family and I have an envelope that I keep out, whether it be charitable donations or stuff going on throughout the year that I'm stuffing in that envelope. That's one way to take care of things throughout the years. That's just gathering of the documents. There's so many things you just talked about is like, hey, purposely incurring income if we have some non-qualified accounts out there. What could we be doing differently from those? We saw last year across the board, there was huge capital gain distributions from some of these bigger companies like Vanguard and stuff like that threw this phantom income on people's tax returns. I can't tell you how many people I saw that have these Vanguard accounts out there and some other institutions. They got these capital gains and boom, they hit the tax returns. All of a sudden, they owe so much more money than the previous years. But Seth, what can we do around those kind of things to make sure throughout the year we're looking over the taxes, maintaining them? Anything else you want to add there?
Yeah, I think it's important to think about other, I'll say, more esoteric but important pieces of the tax code. And so one of the things I'm thinking about is a lot of people think about doing home repair work, right? During summer, it's kind of the time to do improvements, etc. That would be an example of kind of thinking about your envelope with the receipts. Some of those capital improvements could be used to increase the basis of your home. So making sure we're tracking those type of expenses for the long term. Right now, there are benefits for energy tax credits or auto tax credits. Some of them are likely not to be renewed next year. And so that would be something that would be important to be thinking about now. Like, what could I do? Maybe it makes sense to get new windows, to do insulation, to do solar, to get a electric car, etc. All these things. By the way, I'm not making a suggestion that this is what you should do. Rather, I'm saying these are things that you really need to think about at this time. So those are, again, some pieces of the tax code that you may not be thinking about that are related to taxes, but definitely can really swing the needle on your tax situation.
Yeah, and continuing down the thoughts of like homes, I know we have a lot of people we work with that own rental properties out there. What does the bonus depreciation look like next year? We don't necessarily know. We've had favorable bonus depreciation since 2018 until the current tax code sunsets at the end of this year. So it might not make sense to put off a repair to a rental when you can get some bonus depreciation in 2025 on that tax return. So those are some more high level things to consider along the way here. And we don't know what the tax code is going to be as of recording this next year. The things that we just need to think through is like, do we purposely incur income like you had discussed before? And just monitoring things throughout the year. We've had some volatility in the market, right? And when we see volatility in the market, one thing that comes up, I know you and I were making phone calls all through April of this year when the stock market was down, reaching out to the people that have entrusted us with their assets and saying, hey, we're going to do some tax loss harvesting now. We're going to end up doing some Roth conversion strategies while the market is down. So if we do see another dip in the market, that can create another opportune time for us to think about things. We talked about in a previous episode about like asking your advisor, talking to your advisor after those taxes have been done. What are some things that you're advising the clients besides what we have talked about so far, advising those clients, or maybe what they're asking you right now that maybe they should be doing throughout this year?
Well, certainly, I think as you bring up Roth conversions, let's just, for our listeners, I just want to make sure, because it's not too jargony. What we're talking about is taking tax deferred assets like an IRA or a 401k, converting them from an IRA 401k to a Roth type of investment. Think of that like the box. The investments inside can be anything, stocks, bonds, etc. But the Roth is basically now growth is tax free. So anything you pull out from the Roth, and there's a bunch of other rules around that, but conceptually, that's the important thing, I think, for this conversation. And doing so, making that move from an IRA to a Roth IRA creates ordinary income, taxable income, of which you need to pay that tax. So doing something like that, we want to be clear, increases your tax bill by and large. And that's kind of the expectation that will happen. But there are all kinds of really good reasons why you may want to do so. So as Bryan you talked about one of the things, right? If the market drops and then your asset, whatever that is worth less today than it was yesterday, it could make sense to convert that asset over from an IRA to a Roth because of the fact that the asset's the same, it didn't change, but now all future growth would be tax-free. And so that could be a great strategy where you want to accelerate the recognition of income because of a market dislocation where the market drops in value. So that's one example. Harvesting capital losses. when the market drops. Maybe there's an investment that you for whatever reason you may want to sell, and recognizing that capital loss could be really beneficial for using that to offset other assets that you may want to sell but didn't sell because of capital gains. So harvesting those capital losses in a market drop could really make a lot of sense, help to rebalance the portfolio as well. Rebalancing the portfolio when the market's down, which, by the way, what does that effectively mean? It means buying more when the market's down, usually can be a really good strategy with the expectation that over the long term, markets are going to go back up. So there's different proactive moves you can make depending on market conditions. And then again, this is my personal belief. My personal belief is that we have a relatively low tax environment right now, historically low. We have a large debt and we have a large deficit, and it appears like that may be getting larger. It tends to get larger every year. It has been for a while. And so at some point in time, somebody's going to have to pay that bill. That's what I think. And if they do so, the way that that's going to happen is that taxes are going to go up. So it could make a lot of sense for people to do Roth conversions or moving assets into, again, from a tax deferred to a tax-free environment in order to take advantage of that situation, of that future tax rates are going to be higher for you than they would be today. Now, that's where you really need to work with a trained professional, a CPA, financial advisor who does tax planning, such as we do, because you're not, for a lot of people, they may not be working, or there's certain income that's turning on or off. And so you really need to make sure you're looking at that and saying, well, tax rates may be going up, but my income is going down. So what's the net effect? Does that make sense to do now? Does that make sense to do later? Or I'm going on retirement. Maybe now I'm retired and now is a time that I need to accelerate recognition of income for future years. So I think, and be interested in your opinion, I think it's like a large puzzle to figure this out.
No, it always is. And you're spot on with that. And I always like to say is we got to look at the tax efficient strategies that are out there and what can we be doing to reduce that burden, right? No one I've never ran across someone, Seth, and let me know if you have, that wants to pay more in taxes than they actually legally should. Like, I've never met anyone like that, and I'm sure you haven't either, right? Doesn't make any sense. So I look at like what tax strategies could we be looking at? And I'll bring a few up, and I'm sure you'll have a few to add here. But one thing we've seen where interest rates kind of been spiking up artificially, where we've seen that over the U.S. Treasuries going up when they were going down. Some of these bond funds within non-qualified portfolios are down. So what we've done in some of the portfolios is sold those bond funds off, creating that we're harvesting that loss right now. And then we can switch out to a very similar bond fund. So you're not really losing the position too much. You're exchanging maybe from one ETF to a similar ETF or a similar mutual fund that holds similar things. But at the end of the day, is you're incurring that loss to be able to go against any capital gains. So that's one. One thing we've worked over the years, Seth, and I know you know this, is if you're prior to 65, what does healthcare look like for you? In a lot of cases, there's the ability to structure income with tax efficiency. And what do I mean by that is layering different income from, hey, I'm going to take money out of my IRA, my non-qualified portfolio, my Roth, to keep my overall income down so I can qualify for the healthcare subsidy within the Affordable Care Act. So all of our people retiring prior to Medicare, age 65, this is a huge way to take care of some of those tax efficient strategies that are out there. I know there's qualified charitable distributions if we're 70 and a half, and instead of writing the check to church or charity, we can have it directly come from the institution to out of the IRA directly, and we can do that all the way up to $100,000. There's donor advised funds there. Seth, why don't you speak a little bit about those donor advised funds and maybe some other tax efficient strategies that you have in your mind?
Yeah, I think donor advised funds are a great strategy. The way that I call them is a charitable checking account. So You're basically moving assets into a donor advised fund. Those assets are ideally appreciated assets. The benefit of moving that appreciated asset over into the donor advised fund is that you don't have to pay taxes on the capital gain that's inside that donor advised fund. They give you basically a checkbook, kind of a virtual checkbook or a physical checkbook that then you can use to you determine the timing, the amount, and the person or the entity that you're going to be making that charitable contribution to. It does have to be a 501c3, in other words, a legitimate charity. But that's an important thing to keep in mind. It does need to be a charity under the U.S. tax code. So it's a great. In the meantime, those investments in the donor advised fund continue to grow. It sold and may be diversified. So let's say you have XYZ stock and it went up, doubled or something like that, or tripled, etc. You can donate that XYZ stock inside the donor advised fund. It's sold. It's diversified into a bunch of different stocks, no capital gain tax, and then you can distribute that, whenever you want for whatever dollar amount you want.
No, I love that. And you brought up a good point is all of a sudden I bought a stock 10 years ago and it's tripled in value. I can take some of that stock, depending, I know there's limitations here, depending on your income there, but I could put that in a donor advised fund and we get a deduction on our tax return today. And if we contribute the stock in this example or an appreciated asset non-cash, it's a 30% deduction, right, Seth? Is that correct? Up to my adjusted gross income?
Correct.
Yeah.
And
so that's one crucial thing. Keep going. Sorry.
So in general, I do recommend using appreciated stock into a donor advised fund versus cash, just because of the tax benefits available to you for basically not paying any taxes on the capital gains. One thing to keep in mind is qualified charitable distributions from an IRA that's available that you can do starting at age 70 and a half. That is generally a better approach than using a donor advised fund. Reason is because ordinary income is going to be taxed at, usually for most people, probably 22% or more, whereas capital gain tax would be like 15%. So, bang for the buck, again, that's federal, that's not including state, is going to be a qualified charitable distribution from an IRA. One other thing I do want to bring up. So if you're taking the standard deduction, so let's say you're married filing jointly, and you have the standard deduction, that's $30,000 is a standard deduction today. So if you're not itemizing your deductions, then the donations to the donor advised fund, if all of those itemized deductions are less than that standard deduction, you're not getting a tax benefit for that. You get a tax benefit because of not paying any capital gains, but you're not getting a deduction. You would get a deduction if you had enough itemized deductions that's greater than the standard deduction. That may work for some people who have mortgage interest and state and local property tax, maybe medical expenses. But for a lot of people, maybe they're in an apartment or another situation, or they paid off their mortgage, they may not be able to deduct that charitable contribution. So one of the things that we recommend is a strategy of considering a bunching deductions. And that's where donor advised fund can be really helpful as well. So in other words, let's say you're contributing, $10,000 a year to charity. And again, I'm just making this number up, just to make an easy number. So instead of giving $10,000 each year and getting no charitable deduction for that $10,000, maybe it would make sense for 1 year to donate $50,000, get a charitable deduction for a portion of that amount, and then you distribute that amount over time, over the 5 years. So again, in this example, but you can rework it to whatever fits you. But thinking about the strategy of bunching those deductions and really, again, that's where it goes back to 3D chess and time, and really thinking about what am I doing now and how does it impact me over time, and what are those strategies. So that's one thing I was thinking about with regards to that.
No, I like it a lot, Seth. And I want to talk about the people out there that sometimes get a larger refund than expected, or on the flip side, they owe a lot more. Typically, what I like to say, people, let's just take two working individuals. We have a couple together. They're both working W-2 jobs, and all of a sudden, 1 year they owe a bunch of money. What happened? Well, some of the first questions I know you and I are going to ask is, well, what happened here? Did you get any raises? Was there a bigger bonus at work? So on and so forth. And typically you'll find out that they got a big raise at work or they got a bonus. And the one major takeaway is the one employer's W-2 does not talk to the other employer's W-2. So they don't know what the other spouse is making. That's one of the things that could throw it off. If one of the spouses is making $158,000 a year and then the next one makes $100,000, well, guess what? That other spouse that comes in at that 100,000 is already at a 22 or 24% tax bracket, right? So all of those other dollars on top of that are going to be subject to that tax rate. That's something we got to make sure we're in front of. In addition, if you switch jobs during the year, this is a huge one I see all the time. People that have different jobs throughout the year. Hey, I worked 5 months at one job, then I worked the other 7 months at another job. Those jobs don't talk to each other either, right? They're essentially looking at, the first employer was looking at those 5 months of the year saying, hey, this is all you made. Then the next employer, unless you tell them or fill out your forms in a different manner, they're going to look at it as this is all the money you earned year to date. So we typically see people owing a lot in that segmentation of things. In addition, we talked about capital gains that we weren't expecting from some different brokerage accounts. I know, Seth, with us, we work with tax managed funds and tax managed accounts specifically so we don't run into these scenarios. I know you don't like to be the bearer of bad news, and if we're in the industry for tax management, tax planning, and this holistic wealth, that we don't want to have someone owe an unnecessary bill that they weren't expecting. It was something we want to be talking out throughout the year. And then if we're getting more refunds, Seth, if someone's getting a bigger refund, what do you usually tell them to do?
Usually my comment is invest the cash, but also take a look at what's going on. I think it's Dave Allison who said to me, we have to pay the government what we owe, but we don't need to give them a tip. We don't need to have them sit on our money for a year. So really to review, how much are you withholding? What's going on? Why is that situation happening? And adjusting maybe your quarterly estimates or your withholding in order to get closer to reduce that refund.
Yeah, so if I overpay in my taxes, Seth, and let's just say, for lack of better terms, they owe me $10,000, and I file by April 15th, I get my refund back. How much interest did they give me on that $10,000?
Nah, nothing.
But if I owe them $10,000, how does that work out for us? Yeah, we end up owing them some sort of late penalty or interest payment depending on when we pay. So I think that really hits it home for us when we look at, if you get too large of a refund, if you get owe a bunch of money. Some people do like those larger refunds because it's a forced savings. But I would tell you, if that's the case, you probably got some other issues that we need to work through anyways. But throughout all the year, Seth, we meet with our clients. We do those mid-year checkups. We talk about the financial milestones like, hey, I just had someone retire last week. That income's going to drop off. They're going to get a little bit of a deferred comp payout. And it's just planning for these life events. So the one thing I always share with the people we work with, the households that we help, is when life events happen, please let us know, right? We can't read your mind if job change, something like that. It is super important, and that's why we're here to make sure you don't run into these pitfalls. So for next tax season, we just want you to keep an eye on everything. We'll be seeing you throughout the year and anything comes up. But Seth, anything last you want to say to the audience about, how they can manage their money between taxes or any other wisdom you want to share?
I think just one thing that we didn't touch on, but I think is really important, and that's business owners. Business owners have, I would say, kind of a much more complicated tax situation, but that also means a lot more opportunities and a lot more pitfalls. That's something I know, Bryan, you've been spending a lot of time working through and thinking about and structuring. Some of these are relatively complicated structures that are individual, but that's an area that we also can help our clients, have helped and can help our clients with, is those complicated business owner situations. And again, as I'm sure you know and have experienced, right? You don't want to get that experience where a business owner comes to you and says, "Oh, can you help me with my tax situation selling my business?" And you're like, "Oh, when's closing?" Next week.
Yeah. Can you work some miracles and wave the magic wand for me?
Exactly. Right. So those types of situations are things that we need to be working on literally like years in advance, and putting the pathway together with that business owner in order to create some tremendous tax savings, legal, and really putting it in a way that can really help them and set them up, them and their family and their business, for the long haul.
Yeah, I think, Seth, you nailed it. It's also about getting the most value out of your business for those business owners. And when we know years in advance, we have ways to create your business value to increase your valuation, right? You want to kind of be a state-of-the-art, first-class company that's in your industry. And if we have some years in advance, we have the tools to be able to help you get there and get you as an owner so much. We see pretty much across the board, somewhere between business owners have 60 to 80% of their net worth tied in their business. How do we get that out most tax efficiently? I'm so grateful that you brought that up, Seth. Appreciate your time today, and we'll look forward to speaking with you again.
Sounds good. Thank you so much for having me.
Thank you for listening to the Holistic Wealth and Health Podcast. We hope we inspired you to make changes so you can live your best life. If you want to find out more about what we do, or if you want to have a holistic wealth and health financial plan, please call 456-833-7000. Please subscribe to the podcast and share it widely with your friends and family. Financial planning and advisory services are offered through Prosperity Capital Advisors, PCA, an SEC-registered investment advisor with its principal place of business in the state of Ohio. J.L. Smith Holistic Wealth Management and PCA are separate, non-affiliated entities. PCA does not provide tax or legal advice. Insurance and tax services offered through J.L. Smith Holistic Wealth Management are not affiliated with PCA. Information received from this podcast should not be viewed as individual investment advice. Product discussions and illustrations are hypothetical in nature and will vary based on many factors, including, but not limited to, age, health, product, insurance carrier, and product design. You should consult the insurance carrier website and policy for detailed information. For information pertaining to the registration status of PCA, please contact the firm or refer to the investment advisor public disclosure website, www.advisorinfo.sec.gov. For additional information about PCA, including fees and services, send for our disclosure statement as set forth on Form ADV from PCA using the contact information herein. Please read the disclosure statement carefully before you invest or send money.